Private equity is a broad and diverse asset class that involves investing directly into private companies or buying out publicly traded companies to take them private. These investments are typically made by institutional investors or high net worth individuals seeking higher returns than public markets can offer. While private equity is known for its higher risk, it also provides the potential for significant rewards. Below is an overview of the key types of private equity investments, including a newer approach, entrepreneurship through acquisition. Venture capital, or VC, is the most well-known form of private equity. It involves investing in startups or early-stage companies that have high growth potential but need funding to scale. Venture capitalists take on high levels of risk, as many startups fail. However, those that succeed can provide massive returns. VC investments are typically concentrated in industries like technology, biotech, and fintech, where innovation drives rapid growth. Risk and reward: high risk, high reward. Exit strategy: IPO or acquisition by a larger company. Growth equity investments are made in companies that are more established than startups but still need capital to expand. These businesses often have proven revenue models but need funding for activities like entering new markets, making acquisitions, or launching new products. Growth equity investors focus on helping companies scale while taking a minority ownership stake, making it a less risky option than venture capital. Risk and reward: moderate risk, medium to high reward. Exit strategy: sale of equity stake or IPO. In a leveraged buyout, or LBO, a company is purchased using a combination of equity and significant amounts of debt. The goal is to improve the business's profitability and efficiency, then sell it for a profit, either to another company or through an initial public offering, or IPO. LBOs typically target established companies with stable cash flows, as the debt used to finance the acquisition needs to be repaid over time. This strategy can generate high returns, but the use of leverage or debt increases financial risk. Risk and reward: moderate to high risk, high reward. Exit strategy: sale of the business, recapitalization, or IPO. Distressed investing involves buying companies that are in financial trouble or on the brink of bankruptcy. These investors acquire debt or equity at a discount and work to restructure or turn the business around. The high level of risk comes with the potential for significant returns if the company can be successfully revitalized. Distressed investors may also sell off parts of the business to recover their investment. Risk and reward here are high risk, high reward. The exit strategy could involve a turnaround, sale of assets, or even liquidation. Mezzanine financing is a hybrid of debt and equity financing. It involves providing loans to companies with the option to convert the debt into equity if the borrower defaults. Mezzanine investors typically receive higher interest rates than traditional debt holders, and they benefit from the possibility of equity upside if the business grows. This strategy is often used to finance business expansions or acquisitions. The risk and reward here are medium risk, with higher returns than traditional debt. The exit strategy could be debt repayment or equity conversion. Entrepreneurship through acquisition is a growing trend in private equity, where investors purchase small, established businesses and actively manage them to generate steady cash flow and long-term growth. This approach allows investors to become business owners and operators while benefiting from stable income. It's especially popular with individuals looking to build wealth over time or plan for retirement. ETA is considered less risky than other forms of private equity because the businesses being acquired are often already profitable. Risk and reward: low to moderate risk, stable cash flow. Exit strategy: grow the business and sell for a profit, or retain it for ongoing income. Secondaries involve buying existing stakes in private equity funds or individual companies from other investors. This strategy allows investors to avoid the early-stage risks associated with private equity by purchasing stakes in businesses that are further along in their investment cycles. Secondaries offer liquidity to the original investors and can provide buyers with lower risk opportunities in established businesses. Risk and reward: low to moderate risk, medium returns. Exit strategy: same as the original investment, sale or IPO. Investing in real estate or infrastructure through private equity involves purchasing or developing physical assets like commercial properties, industrial facilities, or utilities. These investments often provide steady cash flow through rental income or service fees and can appreciate over time. While not as volatile as venture capital or buyouts, these investments offer stable long-term returns. Risk and reward: low to moderate risk, steady returns. Exit strategy: sale or continued income from operations. Private equity offers a diverse range of investment opportunities, each with different levels of risk and return. Whether you're looking for high growth potential in venture capital, stable cash flow through entrepreneurship by acquisition, or long-term wealth building with real estate, there is a strategy suited to your goals. As with any investment, conducting thorough due diligence and understanding the inherent risks are essential for success in private equity.